I realized how hard it is to be a founder and realized I don't want to do that. I love building businesses, but I don't necessarily love running them once they're bigger. You have to be able to willing to say no to a deal and just move on and not worry about it. I'm looking at all these AI wrappers as startups and they spin them up so quickly. To me, it reminds me of the telehealth startups and the neobank startups. You have no differentiator. You're just a nice user interface. I'm not okay with 90% of my investments going to zero. It's like casting a net. And it's like, yeah, here's 100 of these. I love the category. Hopefully within this net that I cast out there, I got a couple unicorns. I have a hard time with that. It's not a wrong mindset. It's a different mindset. Every deal's got to be either a hell yeah or it's a no.
Welcome to the Deal Flow Show podcast. Today, we have David Mandel, very interesting guest here, who runs a venture capital fund and prioritizes in investing in new tech for businesses. So, David, can you please give us a quick 2-minute who it is that you are, what it is that you do, and who it is that you help?
Okay. Thank you, Ivan. And as you mentioned, I'm managing partner at Emerging Ventures Capital. We invest in US and Canada-based B2B tech startups that are using emerging technologies to solve business challenges. That's the kind of 30-second elevator pitch of what we do. And in particular, we focus on kind of later seed stage, capital efficient startups. And we write checks up to $500,000 into rounds that are usually like $2 to $4 million.
Sweet. We were taking a look into the blog that you're writing. We've been taking a look into your website. We've been taking a look into everything. And we saw that you started as a derivatives trader. We saw that you I believe, and we saw that you, in using that experience, also in VC, you also bootstrapped, or you also built some companies and exited those companies. How did those early experiences structure the way that you look at investing and look into selecting companies today?
Okay. And yeah, never done any derivative trading, at least not officially. But I did. So if we take a step back though, the early days, I was pretty much a math nerd. I was in a doctorate program for applied math. Um, got the master's, never finished the doctorate, dropped out to go into business, and built and exited over almost a 28-year period, 4 separate businesses. A lot of them overlapped in time, but it's 4 businesses, mostly underwriting balance sheet kind of businesses. I'm a lifelong underwriter, and we had everything from a subprime auto lender where we finance cars, and to a auto insurance underwriter that was the second largest non-standard in California at the time. We were insuring at any moment over 1 million cars on the road, and eventually um, exited all those different entities, some earlier, some later. The last exit was 2014. Alliance United Insurance Company sold to Kemper, and I stayed on at Kemper for a couple of years, which was interesting to be an EVP at a public company. And great experience. But to say how that led into this is, I actually was fascinated by AI back in the 80s. It was just a little too early. And uh, that's where I kind of dropped out of math, went into business, and kind of forgot about all that. And it was around 2011, 2012 in my day job, where at the time I had both an insurance company and a finance company, where I started to see really interesting vendors come to me that weren't the same old traditional vendors that can do what seemed like almost magic. And, they would, for example, take massive amounts of unstructured claim notes and give you back some really good insight out of unstructured data. So, and that's what, we would now call natural language processing and some of the other data science stuff that's going on. And that was early days of that. Mind you, that's like 14 years ago. So way before what we have today. And that got me interested in the tech startup world. So I was really completely in my own bubble in the finance and insurance world. All the conferences I attended were around that. I did not know what's going on in Silicon Valley, did not realize the revolution in tech that was happening. I didn't understand about all the tech accelerators, Y Combinator, everything else that's out there. I didn't even really understand the VC world. And I knew about private equity, and we had investors, and I understood the private equity world, but I did not know much about venture capital and early stage tech startups at all. And by meeting some of those, calling on us, so we were customers or potential customers to some of these early tech startups that were focusing on enterprise insurance and finance. And um, being at the time in the role of CEO of both of those, I got to see, and working closely with my CTOs in both of my businesses that reported to me, I started to see some really interesting stuff that got me interested to see, wait a minute, where are these companies coming from? They're doing some of the stuff I wanted to do 25 years ago. And that was the beginning of the end. That was the beginning of where I am today. So it got me to start going out to tech conferences, going out to Silicon Valley and meeting with VCs and going to various events and getting involved in the angel investing world and joining angel groups and just completely getting slowly immersed into that ecosystem to a point where I found that super exciting and wanted to do more there. And the I love building businesses, but I don't necessarily love running them once they're bigger. And both of those at that time were bigger. And it's like, why am I doing this? I really want to, it seems like a once in a lifetime opportunity to be on the tech side. The tech was going through what seemed like a pivot or a major paradigm shift, and we're on the cusp of some kind of um, you know um, explosion there in new technologies that I wanted to be a part of. And I hired investment bankers for both and got out of both of my operating businesses basically so I can focus in some way or another on being involved in this tech revolution that was going on. And wasn't sure what form it was going to take. So I did exit both businesses within about a year and a half of that and started doing some angel investing and spending more time in that whole ecosystem any way I could. And eventually it turned into being a full time angel investor. Never did start anything. By being an angel investor, I realized how hard it is to be a founder and realized I don't want to do that. It's like, I'm past my prime as far as wanting to dig in and be a tech founder. I should leave that to this next generation of really bright young entrepreneurs that are gritty and willing to put in the hard work. And I'm probably not there. And I should just sit back and support them. And, you know, instead of just being all in on one, I can support many that way and see kind of be in the know of everything that's coming out and be on the forefront, on the cusp of all emerging technologies and not be left behind. There's this fear of being left behind and the aging out as things are changing under you. So that's really the longest story how I got into what I was doing. And I did that. I've invested back then in over 500 startups as an angel investor over about a decade. And before I started the fund. And in 2019, a partner and I got together because there's a lot of other people by then that were meet up with me that were curious about what I was doing and I'd be so excited about tech and angel investing. And they're like, "Oh, that's cool. Let me know next time you write a check." And it's like, okay. So I wanted to write bigger checks so that I can support myself. I was starting to run thin on capital as, I've made over 500 investments. And while I had some good capital from my prior exits, you don't get exits from startup investing too quickly. It's like a 10 years plus cycle. So starting to run out of capital, it's like, okay, let's make a fund so others can co-invest with us and so we can write bigger checks and have a little more formal process. And that's where in 2019, Emerging Ventures came from. We made Emerging Ventures Fund 1. We said, okay, it will be a small kind of test fund. And we did that. We raised money from about 20 LPs, which were all former associates of mine, people I've done business with in my prior life who knew me as an operator from insurance and finance. And so that was kind of just going back to our friends and saying, here's what I'm doing, that I'm in this world now. And they're like, okay, we'll support you. And they're excited about it. And I got my 20 or so LPs, and that was Fund 1. And then in 2021, we launched Fund 2. And that's where it continued. It got a little bigger and got a few more referrals, started to have some of a reputation and had a track record. And, you know, and now we're on our third vehicle. So that's where we are today. Today's 2025 already. So we're in the midst of investing from our third vehicle now, and that brings us to the present.
That's fascinating.
It's actually kind of a typical story of operator exiting, turning investor. And I've heard this from so many others where they go from angel investing on the side while they're an operator to exiting and going kind of doubling down on angel investing to eventually doing some kind of formal structure, whether it's creating angelless syndicates or a formal fund structure. But it's so common. It's like seems like half of the VCs are former operators, and the other half obviously are coming through the traditional world of being working their way up in other firms and eventually going out on their own. And there's always a debate who makes a better investor, a former, someone who went through the ranks at a VC prior or has never operated a business, or those who have been operators and kind of understand what it's like to run a business.
Absolutely. That was actually gonna be my next question was, I'm just curious, coming from that background as an operator and having multiple exits and clearly running multiple successful businesses as an actual CEO, and I'm sure wearing other hats within the business, how is that, do you feel like that gives you a unique, edge or advantage as an investor?
And I have a unique background where I was a lifelong underwriter. So to me, this just scratches my itch for underwriting because, it's just another class of investments that I'm underwriting. You're underwriting auto loans or you're underwriting startups. They're not the same, obviously, but it's the same concept in some way where you have an underwriting process. And by being a lifelong underwriter, I'm not a salesperson, so I don't have that FOMO. I can care less about missing out on deals. I don't live in a state of FOMO. I had to shed that early on in my career as an underwriter. So you have to be able to willing to say no to a deal and just move on and not worry about it and not worry about what you're possibly missing out on. We used to have a slogan on the wall in the underwriting department at my auto lender. And and I my my favorite saying still today, and what it said on the wall is, "When in doubt, say no." And that's still how I feel today. If you don't even have to be able to articulate it. I used to tell my team that back then. It's like, go with your gut. I'd rather you err on the side of caution. If something doesn't feel right, just say no and I'll back you up. It's okay to say no. And you don't have to be able to fully articulate it. And another saying that I steal from others today, I didn't invent that, but it's kind of a more positive spin on it that every deal's got to be either a hell yeah or it's a no. So if it's not a, oh my God, this is amazing, I have to be in on this, then it's a no.
Interesting. With your so I've got experience in the life insurance industry. I shadowed a life insurance agency owner. He ran an agency of over 3,000 agents across the country. So I shadowed him. So I guess the underwriting is if you were to use, would you agree with this statement? If you were to use an analogy as or not an analogy, but a simplified explanation, the underwriting process is essentially the risk assessment to see if it's worthy of approving this policy, meaning if it's worth taking that bet, because really insurance is just
Mhm.
risk
Yeah.
assessment and
And
then knowing whether or
right.
not it's
And life insurance is very formulaic, although there is a little art to it trying to fit, but it's very formulaic. And there's not a lot of leeway often, although there's some. But especially when people aren't super prime, when you get into people with, potential risks, seeing where on the chart to put them and then see if there's a price for it. The same thing with auto finance when we did the auto finance. There, in simple terms, not to get distracted, but there isn't a rate for everyone. You can't have the mentality that just find the right price because there's a lot of deals that shouldn't happen. There's a lot of people trying to buy the wrong car at the wrong time in their life, and they just shouldn't be buying that car. And you're not doing them a favor by approving them, because by approving them, you're kind of telling them that, you know, you know, it's okay. You should have that car. You can afford it when it's not okay. And they'll very likely just, be ruining their credit and losing their down payment because they won't be able to afford the car without getting it. And that's the same thing we would teach our team back then. So there's not always a price for everything. And very, very true of startups. So, on one side, not all startups are venture backable, and not all startups should be venture backable, and the vast majority should not. And that's another whole conversation. But I spend a lot of time explaining to a lot of startups why I think they shouldn't raise venture capital, because a lot of them really shouldn't. They're just not fitting the mold of, what a venture capital startup should look like. And even, we can get into that if you want to, but that's another whole kind of thing. And then for me in particular, I say I like capital efficient startups. And so it's not enough to like the product and like the founders and like how they work together. But then obviously you want to see that with what they're raising today, the basic underwriting of a startup is pretty simple. With the round they're raising today, what's the likelihood that they will be able to reach the milestones they need before they run out of this money to raise a much bigger round at a much higher valuation from a credible large VC, and let's say whenever that is, typically 18 months from now. So, if you have a startup that's raising $1.5 million today and they're burning 100,000 a month, so they have roughly, a little over a year of runway, kind of typical for a seed stage startup, right? And it's like, okay, then a year from now, what are you going to look like? And if I put on the hat of a Series A VC, would I give you a large check a year from now? What would that look like? What would you need to look like for me to be able to write you that big check a year from now? And, so let's say they want to be worth $10 million today and they're raising 1.5 or $2 million on 10. It's like, what would it take for them to raise 5 on 25 approximately, say a year from now or 18 months from now? And what would they have to look like? And what's the chances of them getting there? And that's the risk return. So that's the underwriting part. That's the risk return profile. So once you like somebody and you like the product and you're saying, this is something interesting and I like these people and I can see myself wanting to be attached to them and work with them and, be excited about what they're building for the next 10 years and follow their progress. So that's step one. I just have to like something. If I see a deck and it's just not interesting me, it's just not interesting to me. It doesn't matter if it's at the right stage and anything else. It's like, well, and and that's hard to explain to founders too, because they'll send me a deck. I was like, yeah, I'm not interested. It's like, but why? But right at your state, we seem to meet all your requirements. And it's not one of those things where if you just check off a box, you get a check. I'm going to see 30 deals a day approximately, and I'll write maybe 1 to 2 checks a quarter. And so it's less than 1 in 1,000 that get a check. And, it has to really be the one. It's like going through a dating app looking for a spouse more than going to a bank asking for a loan. You go to a bank, ask for a loan. If you meet all the requirements, you get a check and they can fund everyone who meets the requirements. And they want to fund everyone who meets the requirements. In our case, we only want to write 1 or 2 checks a quarter. And then we're going to stay married to them for 10 years. And I'd rather write, you know, 2 $500,000 checks per quarter than 10 $50,000 checks per quarter. And so I'd rather find the right one and write them a bigger check than have a bunch of deals that I'm kind of okay with because they met my requirements, but don't really love them.
Yeah.
I need to really love them.
What's so interesting about what you said is that because we're kind of having a conversation within a conversation, so unless you understand what, um, what the underwriting process actually is and what that even is for insurance or for loans and everything like that, it's essentially you're like David explained, you're evaluating the risk on whether or not they're going to make their payments and this loan will be a success for the bank that's giving out the loan, or if it'll be a success on the insurance company, just I guess essentially they're banks. Um, Whether or not the insurance policy will be cashed in, because their job will whether or not the insurance policy will actually be cashed in or not. Because if it gets cashed in, technically they lose on that bet that they're making. So essentially, what David's saying is he's bringing over that same risk assessment into his investments, and it's actually really fascinating because we it's not like it's the first time we've asked a question on somebody on how do you evaluate the startups you're investing into? How do you evaluate the companies that you're buying as a private equity firm? Because we talk to private equity guys as well. It's always personality driven of the founder and, whether or not you'd grab a cup of coffee with them and believe in them. And then at the end of the day, especially for private equity, it's like the unit of economics of everything and how the business structure is and everything like that. But you're taking it a whole layer deeper of what are your benchmarks and what is your probabilities of hitting those benchmarks. Um, I guess, can you go a bit deeper into how else you assess risk? Because I think honestly, for anyone that's listening, that I think would be a huge takeaway for everybody here because you're investing in ideas. So you have to be like the ultimate risk assessor.
That's true to some degree. I always say that I don't do a lot of pre-seed because I don't know how to judge ideas. I'm an underwriter by heart, and I don't feel like I have any particular skill at looking at a founder and idea and knowing who's going to make it and who's not. So that's why I invest in the later seed stage because I look for traction. I look for a live product. I'm basically looking for three things at a minimum for them to meet the requirements before I can even dig deeper and have a meeting with a founder, which is a live product, and solid traction, meaning they can sell the product and the right customers are willing to pay for it. And um, they don't always, you know, have all, sometimes I'll have one or two out of three, but not three. I need all three of those to really even consider investing. And then um, from there, then we go to that next level. So let's say they come to me and it's an enterprise software company. So pretty standard thing to understand, right? There's software as a service. They're charging monthly or annually for some enterprise software. I want to, so now let's say they've been on the market for 6, 9 months. They have 20 customers. They have 400,000 in ARR. And now they have a clear funnel. They have projections to get to like 1 million by end of year and, 2.5 million by the end of next year. Pretty typical kind of roadmap. So we just tear that apart. We dig into that and say, okay, how are you going to get there? And what is it going to cost you to get there? What does your expenses look like? And how do your expenses grow in order to get there after this raise now? It's like, why are you raising money? It's, oh, we need to hire more salespeople. We need to do this and do that in order to increase our revenue. It's like, okay. And we just analyze their forecast and tear it apart and kind of work with them to see if it makes sense. And then say, okay, if you do everything you just said, if you raise this, say 2 million today and spend it on growth, and with the sales funnel you have and the process you have, and what's the likelihood that all this will play out? Would this really play out, or are do your numbers make sense? Your ability to convert your sales funnel into customers and keep the churn down so that you can have, let's say, 2 million in the ARR in 18 months and then raise a nice Series A, and that's probably the minimum nowadays for a Series A is 2.5 million on a fast growing SaaS company for a Series A VC to consider you. Um,
That's fascinating. You mentioned earlier in your last point that you're looking at 30 deals a day and only a small percentage that actually pique your interest or even getting to that stage where you're willing to dig deeper and look at the numbers and everything. What kind of constitutes, is it really like an intuitive feel of like, this is an interesting idea or a market or whatever that's allowing you to, move into that next phase? Or what are the characteristics of a business that, you would be interested in digging deeper into?
yeah, yeah, no, that's a good question. And primarily, the main filter is just being on thesis to everything I just said. So being, you know, first of all, being a B2B tech startup, and then secondly, having enough traction. Way too many are just too early. They're really kind of at the pre-seed. They're just launched an MVP and just starting to scale. It's like, oh, we launched 4 weeks ago and we already have some early paying, or we have pilots or we have this. It's like, okay, now come back to me in 6 months. Show me that you can convert those pilots to paid customers. I don't care about your pilots. And, so a lot of it's just that. And I'll literally just put that in a one line reply. It's like, looks interesting, too early, you're at the pilot stage, stay in touch and check back in 6 months. And they either do or they don't. But that's all I can do for them today. Is no point in me scheduling a 45-minute Zoom and having them dig through their whole, you know, pitch just to tell them that at that point. And I there'd be I don't have enough time in the day, and I don't have junior analysts doing that for me. So um, I would meet with them myself if it made sense to. At that stage, I think to save them and myself that time and the information overload for myself, of I would just give them a one-line reply. So I try to be really conservative on scheduling meetings. I never have more than 5 a day, but I try usually not to have more than 2 a day. I definitely won't meet with more than 2 new different founding teams per day, because I mean, that's a lot to dig in and learn a whole business, basically. You're trying to internalize an entire business, and you want some time to think about it after that. Uh, you know, y 2 a day is enough of new businesses to put in your head. And, and for me anyway, I said, I'm and then to do everything else you're doing, you have a lot of follow-up with existing portfolio companies, you have everything else going on, and but learning 2 new businesses a day is more than enough. So I really, like, I try not to schedule more than 2 meetings per day like that, where I'm doing intros, and then I'll have some follow-up meetings, and then if I like what they're doing, the next step really is usually to ask for a data room, and then I wanna just dig in. I wanna see how they think about their business, and I'll spend and that's where I give it to my partner, Bennett, and he'll also spend some time on it because he likes data rooms and Excel worksheets, and he comes from an investment banking background. And so we dig through and kind of understand how they think about their business, um, from the paperwork up, whether their customer contracts look like, whether their financials look like, whether their projections look like, what does their funnel and their dashboard look like if they have one, what CRM are they using? How are they using it? And understand how they feel and think about their business. And then have another in-depth meeting with them, usually about a week later, to go through all of that. Because the first meeting, all I saw was a deck. So by the second meeting, I probably spent a couple hours in their data room and understand their business and can kind of have a much deeper level kind of session talking about details of that stood out, either good or bad, that we had questions about from the data room, and dig into that, and see from there. And from there, it often either gets really interesting or falls apart.
So you're basically looking for that to even have that 45-minute conversation. It's the actual traction, the numbers behind it. They have customers, they have a product that's live. Are there any particular, niches or industries or, specific tech that is like a green flag for you? Or like, okay, this is even more interesting just because it's
And it's more of what the red flags are. At any time, there's, you know, the hot, flashy topic, and I avoid those. And as an example, you know, um, we went through cycles, but during COVID, there was a gazillion um, telehealth startups, and I knew it's an area that's hot, and there's going to, and it's needed, but we don't need 1,000 of them. And within months, you can see like 1,000 of them. So it's like, okay, and it's so hard to sell into healthcare. It's not easy to get a hospital system or a medical group to just bring on a new tech vendor. They're very cautious and they move slow. So, you know, I avoided the entire category because there's just too much noise. There's like, every day I was seeing multiple, and it's like, I can't tell them apart. I'm not an expert in that area. They all are brand new. They're all, so I just avoided it. The same thing around the same time, but a little bit before that. So even before COVID, there was hundreds and hundreds of what I was calling neobanks. You call them fintech startups in general, but in particular within fintech, there was neobanks. They're basically, fake banks. There are banks without a banking license. There are banks that it's like in the insurance industry, being a GA, a general agent. So you're acting like a carrier, so Nick's like they're acting like banks, but they didn't have a but they were asset light. They didn't have a banking license. They were renting someone else's license. So they made a deal with some small bank to use their license so they can be a virtual bank. And I mean, the most successful one is probably Mercury. And they did a great job, and Ahmed did a great job. Imad did a great job, but there's hundreds of them. I would see several a day, every day. And it started to get ridiculous. Everyone wanted to be a bank for a smaller and smaller niche. We're a bank for migrant farmers in Fresno. We're a bank for teens. We're a bank for female Black students in Berkeley. I mean, and I'm exaggerating, but it was becoming really, really niche. And it's like, why do we're a bank for Indian immigrants coming to go to school in the Bay Area? That was literally one of them I saw. It's like, why do these Indian immigrants need their own bank? Why can't they bank it? What's going to attract them to this? Why can't they bank anywhere else? It doesn't make sense. Same products. You're not offering anything different. They speak, they act like anybody else. They speak English. They're American students. Why would they want their own bank? And it's like, oh, well, immigrant students have unique problems and we help them and they need their own. It made no sense. So it was almost hilarious. And if you look at it that way, but there was hundreds and hundreds and hundreds, and the vast majority failed, obviously, because they couldn't offer any kind of unique differentiating product, and they're using someone else's license. And it was all about eventually the technology, right? Being technology first kind of virtual bank. So they had no branches and no bank license, and they're really just a software stack. And some had some pretty darn good software. But at the end of the day, they're all at the end of the day wind up calling a lot of the same APIs from other. So the guys who built the infrastructure did pretty well or created something well. A lot of those other ones were really just calling everyone else's APIs. And the same thing then went on with the, Web3 and NFT craze and everything else. It's like for a while, every startup had blockchain in its title and its name. And most of those pitches, and this is probably like 2019-ish, maybe 20, where blockchain was everywhere. That's where we're first doing Fund One, and every other 20, maybe 2020 as well. I don't know. I lose track of time, but it seemed like everything's blockchain, blockchain, blockchain. And we did make some blockchain investments, but the vast majority of blockchain startups that we saw had no legitimate reason for using the blockchain, and the founders had no expertise in blockchain. They just wanted to ride the hype.
I'd
And
yeah, I'd love to get your thoughts on there's
so
a hype train
I
going right
avoided
now.
all of them back then. And then the NFTs came out, and it was NFT everything, and it was really frustrating that some existing portfolio companies even pivoted into doing stuff with NFT because they felt like they're missing out on the NFT craze. And but anyway, I mean, yeah, I essentially did almost nothing in NFTs, but there was a gazillion NFT startups trying to help mint NFTs for anything and everything, and they all thought that they're gonna work with enterprise customers to use NFTs or help them get on the NFT bandwagon. And, obviously, that didn't materialize that way. And all those things are great technologies, but you don't need 1,000 startups. They're almost like just consulting firms. There's like 1,000 startups claiming they have amazing tech, but at the end of the day, they're just trying to go after enterprise to help them do something. And, you know, so I avoided all of that, and there was a big craze about that, and there were entire funds dedicated to that. There's like an entire blockchain fund. It's like, okay, I'm not a complete expert on any of that, and I'm not sure what's going on, and I'm just going to avoid all of that and stick to my fundamentals. A little bit like Warren Buffett, where he just sits out a lot of that stuff and just sticks to what he knows. And again, it's just not having FOMO. It's like, if that's where the world is today, great. I think it might just be a fad. I might be wrong. It might move on. I might be missing out on some amazing deals and like the next Amazons of the world, but so be it. And I just sat through all that and did practically nothing with that. The blockchain's an amazing technology. There's some amazing use cases that are great. Well, for example, I mean, the way it can help with fraud in third world countries and they got some serious problems, and this really does some really good stuff. Having an immutable record that's a single source of truth and that's immutable, that can't be falsified, is amazing. What's done to even protect property rights or certain governments of certain third world countries switch their entire, say, property registrar to be on the blockchain. That's amazing. So you don't have some bully, go to some farmland that's been in someone's family for 5 generations and say, get out of here. This is mine now, which they used to be able to do because they can just, there was all paper records and, they can go, they can have corrupt officials or, officials that were kind of coerced into falsifying the records and going back and changing title. And we don't think about that in the US. We have a pretty good title system, although there's still some title fraud. Um, uh, in third world country, that was a huge problem. And, so blockchain was a huge solution. We've one blockchain company we invested in back then, it's called DigiBuild. They use blockchain as smart contracts, which is smart contracts, again, another amazing technology, has some great uses. They're using it to um, manage, make large construction projects more efficient by settling all the inter-vendor transactions that need to happen uh, with smart contracts on the blockchain, and makes just the life of the administrators on that side so much more efficient. And that's actually a legitimate use case. And there was a few others, but for a while, every startup had blockchain in its title. And a lot of times you look at what they're doing and it's like, where does the blockchain fit in? Why the hell would they need to put this on the blockchain? And they were trying to force it to be a blockchain company when it had no legitimate reason to be on the blockchain. And
I'd love to get your thoughts on that. There's a new trend right now, and it feels like a new startup is coming out literally every week, or at least 2 or 3. And, I'd love to get your take on it because you're B2B software, so, like, this is exactly your lane. And there are these new B2B softwares that are all AI agent swarms,
yeah,
workflow automation, and all this other
I'm
stuff.
struggling with that for the last probably year and a half. It's been, like you said, every startup now is an AI startup. And it's the same but different because, I mean, the truth obviously is that eventually every startup will be an AI startup. Every business will be an AI business. No business, it'll be very hard to not have AI somewhere. But that's like saying that every startup's an internet startup and every AI is a database startup. You don't even think about that. You don't talk about that. It's a given that every, you know, software business uses databases and the internet. It's a tool. It's an automatic thing. It's just there, right? And they're all hosting them in the cloud. And you don't even care anymore if they're using Azure or if they're using Google or whatever they're using or AW. It doesn't matter what they're using. If it's AWS, you don't care where they're hosting. It's a given. No one has to say anymore. I'm an internet business, and or I'm a cloud-based business. SaaS. It's a given. And same thing is now for AI. Everybody has to use AI, and they are using it all internally. I mean, YC just said that a big chunk of their last batch of startups had 95% of their code AI generated. And that was amazing. And despite the fact that the founders were technical and more than capable of writing that code themselves should they choose to. And that's pretty crazy. So it's changing that way. But at the same time, I'm looking at all these AI wrappers as startups and they spin them up so quickly. And I'm not investing in any of them yet because it's the same thing. To me, it reminds me of the telehealth startups and the neobank startups. You have no differentiator. You're just a nice user interface. You're a wrapper. You're creating, you're calling APIs of whatever flavor of the month you have for your LLMs. And uh, you're doing something cool with it and you're getting some traction. You're getting some businesses to use you. But what do you have that's differentiated? What do you have that's proprietary and that's going to be sustainable? And the answer is usually nothing. In my mind, anyway. I can be completely wrong. All I know is there's way, 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 way too many of these. There's thousands of them being popped up now from every accelerator everywhere, right? They're spinning up like crazy. Every smart young, say Stanford graduate, just pick on Stanford, but graduate from any kind of site wants to go out there and do an AI startup. So they're all getting together, and in 3 months they can pop out a really nice looking AI startup that does something using AI for some vertical or for some smaller niche function, you know, they're trying to be really specific and like, okay, we help lawyers draft responses. We help lawyers monitor cases. We help lawyers with depositions, whatever, right? There can be like 20 different ones just for law firms. Um, and then I see that where eventually all these things will be features in the workflow of a law firm. All these things. I don't think the lawyers are going to go out there and buy 20 different AI tools that are desperate tools and have them running on, their core systems are going to have AI as a function or are going to integrate with particular these. So some of these startups might get bought out by the big boys and get lucky exits that way. And many of them will probably just fade away eventually.
Yeah, what's interesting about what you just said is that the AI wrappers, the LLM wrappers and everything like that. There's a debate going on right now of the relevance of B2B software eventually as a whole. I'd love to get your take on that because if all AI can generate code that actually works, what's to stop a company from going in and then just making all of their own software for all the solutions that all these B2B so they pay these subscriptions for these yearly contracts, these invoices that they're paying every year. What is your vision or take on where B2B software will be 10 years from now if every company is capable of building their own
Sure.
tools?
Well, 10 years is a long time. And having vetted solutions is not always a good thing. Um, the, I mean, AI and the use of LLMs behind the scenes will be built into every software we use. That's guaranteed. It's, if any software, whether it's enterprise SaaS or whether it's consumer applications, don't use AI, they'll fall behind and someone will replace them that is using AI. And they buy versus build. I don't know. Uh, haven't thought about that enough to give you a good answer. That's a really good question. I I'm sure there's still going to be demand for someone to give you the right software. I think a lot less. So what's getting easier is implementation, onboarding, configuration, all that kind of stuff. Like a lot of that consulting work of implementing a program and mapping data between systems and all that, that's getting so much easier. I see that's helping startups get into enterprise because they can integrate a lot better. They can onboard customers a lot better. But um, at the same time, that's going to probably dislocate a lot of consulting kind of work. So I'm not as worried about SaaS. Like, let's say, talk about every business has to have a CRM, right, of some sort. Is Salesforce and HubSpot going to be out of business? Probably not. They're a platform, they hold your data, and you still need to hold your data somewhere, and it's going to be in the cloud. So, will their pricing have to adapt? Maybe. Could they charge the same as they do now? Maybe not, but they probably just have to offer a lot more. Their margins might shrink if they have to do a lot more with AI in it to provide you a reason to use them. And they'll have to adapt quickly and have the latest tools in there so you don't go outside of them. And they add a lot more, if they, well, like Salesforce and HubSpot both have marketplaces. So third parties can build cool tools like AI agents that can use the CRM, use your platform to do work as if it's a human. And that's where I think it's going, where you'll need less humans and less implementation, and you can do things faster. I don't see the main platforms necessarily going away, but they might have to charge you less to stay relevant and to justify their existence. And they might also have higher cost if they have to provide you more. So if they're giving you more for less, by definition, their margins go down.
I've got a interesting question. Earlier, you were talking about those neobanks and how a lot of these startups will basically just take kind of the same solution or a commoditized product and just try to niche down, super niche, or like, we're an AI startup for lawyers or whatever. And the way you view that is, is really, really interesting because I have kind of an example. You brought up CRMs, like an example that I can think of if you're familiar with Go High Level. It's basically a HubSpot or a CRM that's super niche down to agency owners, and they were able to obviously build specific features and stuff for agency owners, and they've crushed it with that approach of niching down and building the solution for them. Although it is a very similar product to like say a HubSpot. Um, your take was very, very interesting, and I'd love you to kind of expand on it. So, like, if
I
someone
actually like vertical specific SaaS, um, because build the hardest part of implementing something generic like a Salesforce or a HubSpot, and that's where consulting firms made fortunes with all the customizations and all that work, is getting it to suit the workflow and terminology of a particular industry. In my opinion, anyway, that's why I've seen. I think that so they're so generic. So having industry specific solutions, and whether it's something that sits on top of a Salesforce that you're buying from, or whether it's a straight up from the ground up SaaS that's still behind the scenes, obviously building using a lot of existing infrastructure, then using existing database systems and everything else, and uh, they're using third party AI tools. They're using everything off the shelf, but they're building a workflow solution and a interface, and everything has a terminology and workflow that suits a particular. For example, I've seen a good one for dentists. Um, and dentists obviously have a unique workflow and do something that's, different than other industries. So do they need their own software? Probably. They wouldn't do very well sitting on the HubSpots. Uh, and the same thing's true. You can think of everything. And obviously lawyers have hardly ever use a generic CRM. They have specific platforms that are designed for law offices that do everything from case management to customers management, billing of hours, everything in the terminology and workflow of lawyers. And you can go on and on and on and on and on. And you're absolutely right. Insurance agencies have agency management systems, and they'll have all the right integration with their carriers and do all the policy management and whatever else needs to be done. Every industry has its own loan management systems to manage loan portfolios for lenders, and on and on and on. You won't want to sit there and adapt a HubSpot for that.
So, where's the line between, you're niching down with something that's undifferentiated and it makes no sense? Is it because they're solving such a small use case that's eventually just gonna be like some agent that is just a small part of their workflow? Is it because it's, like, too niche in the problem they're solving? Or, like, how are you thinking about the difference where you're looking at it and you're like, "This business is not valuable, it's just the same exact product, but, positioned for lawyers," and it's such a s
Well, position for lawyers is great because lawyers is a big market and they can afford to pay for things. So, their time is valuable. If you can save them time and make their life more efficient, they'll pay attention.
But is it just the scope of the problem you're solving? Like you said, with a CRM, there's so many applications with so many mini workflows within the CRM that are valuable. Would you say it's more of the scope of the problem you're solving for that industry?
So what I didn't like is seeing these AI wrapper startups that were solving a small particular issue, say for lawyers, and that's where I was going before. And I'm thinking that that's basically a feature, not a product.
Right. Okay, that makes total sense. Because, like you said, like it
Because
like that.
you're gonna need 20 of those, and the lawyer's not gonna want 20 of those, and eventually that will just built into his core system.
Right, okay.
He won't need this third party product because it's gonna be a feature in his core system.
It happened like 3 weeks ago with, GPT. They relaunched a new image generator, and a lot of these wrappers are just I don't use them anymore. Like Midjourney, I canceled the subscription. Midjourney generates images off of text. I canceled it, and all I use is ChatGPT's version because it's
So yeah, and if you're a lawyer, you spent 30 years, you have a firm, your whole firm's on this core system. It has everything in it. Now, someone comes and sells you a tool that can say summarize, you know, do legal research for you. It'll go out there, but you're going to have to take your case and upload it to it, and it's going to scan it, and it's going to go out there and do some legal research and come back with some, maybe relevant um, reference cases that you can use, right? Uh, well, eventually, if there's a button in your core system that does that, you're not going to use this third party product anymore. You're not going to go through all those extra steps. You'll just press the button in your core system. So I think that's a band-aid until your core system comes up with that feature. Because they're not going to sit there and twiddle their thumbs and say, they're going to see all these and like, oh yeah. And if it's as easy as just taking what you already have and calling a third-party LLM's API and getting an answer back, then, eh, why wouldn't they add that to the next version? So I don't think it's a sustainable business. If you're doing this, like, oh, we got all these lawyers to pay for because it's a really cool. It's like, okay, yeah, it's a cool new toy and it's not that expensive, so they'll pay you for it a couple $100 a month to use this and play with it for now because it's saving them some time. But the minute they have that as a core feature in their core system, they're not dumping their core system. That's the problem. You're not getting them to switch to you because you only do that little thing. You're not managing their whole business. So once the platform that's managing their business also adds that feature, you're dead.
You're done. Right. That's super interesting and very valuable, I think. I have an interesting question for you. Have you seen any like basically tech-enabled services? So, like, rather than building the SaaS to solve a problem, like, you start as a service company and you're solving, an entire scope of workflows, and you're building kind of like agents and whatever in the background, or some form of tech that's not maybe you have like a tech-enabled service. Have you seen any tech-enabled services see a lot of success with building that solution and then going and building the tech and transitioning into SaaS? Is that common?
I've seen a lot of consulting, but I think what you're saying, where businesses that were more consultants doing providing services to customers, and they start building tools for themselves to make their job easier, and eventually, by the time they're coming to me to raise money, they try to turn that set of tools into a SaaS product, so that other customers can just license that SaaS and and not need to hire the consultants and switch from a consulting to a SaaS. So yes, that is a theme. There's a lot of those out there. I look at each one individually. I'm a little suspicious sometimes about whether it should still be considered like a services business, or whether, so you want to see how self-serve the product really is and how much human intervention is still needed and how they really got over the point, because a lot of usually at that point they're pretty smart professionals that were doing good consulting work, but you want to look at their prior, so they're not really technically startups because they might be older companies. And first of all, it's like, why are they raising now, and if they're making it, and are they, and that's a lot of times, many of those, I wind up determining that they're probably not venture backable and shouldn't be raising venture capital. They're, you know, they, they are now a SaaS business primarily, but don't necessarily need venture capital and aren't necessarily going to scale at venture scale. They're not going to have the exponential hockey stick, or probably shouldn't aim for that. Because they're going to continue, their sales process is the same as it was as consultants. Just what they're selling now, and they onboard them, and then it's kind of off on their own. So they're losing some of the recurring work. So they have more time. They need less consultants. Um, but yeah, I just told one last week, and three professionals that were the partners in this consulting firm, some nice high-end stuff they were doing, and they have the product, and they really, you look at all their prior revenue, and it was almost on the decline. They used to have like a solid $2 million a year plus of revenue, all from their consulting, both initial and ongoing, for the work that they would do uh, on enterprise customers. And they had a good portfolio of enterprise customers, and they built these tools. And now, as they're shifting to SaaS, they want to go out to market. They want to raise money, and they want to go out to market and try to sell the SaaS more. And in fact, their revenue's been down because they've been focusing on building the product and trying to switch people to the product and doing less of the consulting. So, which is kind of, they got a little bit into a cash squeeze, and they were down to like only maybe 1.2 million in revenue instead of 2 million in revenue, because they shifted focus and they're dealing with this. And that's why they got into a cash squeeze. And that's why they want to raise money to kind of get over the hump. And maybe they need a partner, maybe they need some angel capital, but it's not really venture backable because they, by their own admission, they won't have to raise again. And it's like, okay, why would I go in on this safe now that's never going to convert to a priced round, because you're never going to raise money again. It's and they're even, they're set up as an LLC because they used to be a consulting company. They have tied the three founders our partner, they have titles of like managing director. They're just not set up to be, they're not a C corp, and they can convert and all that. But I think you're trying to force, it's one of those trying to force, a round peg into a square hole. It's just not a venture capital startup. They're not a startup, and they're not venture backable. They're a consulting firm that now has a nice piece of software, and they'll be a more efficient consulting firm.
That's fascinating. That was very,
Does
very
that answer
valuable.
your question? I'm not sure if
And
that's where you were going with
you
it.
nailed it. Yeah, you hit it right on the head. That was like exactly what I was curious about.
And it's, I mean, you're pretty much exposing a lot of, you're calling BS on a lot of these uh, new tools that are coming out, or a lot of these new, um, because I mean, I talked to a founder a few weeks ago, and they've already gotten backed by YC, and they would fall directly into the category in which you would not touch with a 9-foot pole.
Yeah. And some of these, don't get me wrong, some of these will be amazingly wildly successful, because they will figure out how to scale. They'll be great at the sales side, and they'll, exit pretty quick, 2 years later for a great multiple to somebody. And they will be the feature of that bigger system. But I can't guess which ones. There are just so many of them. When YC itself is pumping out hundreds of them, and everybody else is too. So there's thousands of these. And I just think they just can't all survive. There's thousands and thousands and thousands of these AI wrappers today, LLM wrappers, because it's the coolest thing to build. It's the easiest. It's the low hanging fruit. If you're going to do something new, you're a recent, comp sci grad, you're going to build something that's an AI wrapper. It's almost a given. What else are you going to do? And, and you can get some early traction. You can find some problem that you're aware of. Like maybe your uncle's a CPA. So you go see how they're, oh, let me help you use AI. And they build something for CPAs, and they get referrals to a few others. Before you know it, they have a few 100,000 in ARR, and they go raise some venture capital. And, do they become successful? And 2 years later, you know, haven't, get acquired so that they can become the feature for some large accounting backend program? Maybe. But, how many of those can wind up having that path versus how many will just eventually, you know, shut down because customers will lose interest.
Right.
And what they're doing will be already a feature, will be built into something else, and selling it standalone would just become too hard.
It's fascinating. I think
So I can't tell. It's not because I can't tell, and I don't have a crystal ball. I'm just being conservative and shy and wait for that. Say time can, this is being recorded, so time can prove me wrong. I can be completely off, and it can be that thousands of these will all wind up being successful. I just can't picture a world where that's the case. And I really suck at trying to figure out which ones. I cannot look at a founder and their idea and tell it apart from the thousands of others and say, yeah, you guys are amazing. You guys are going to make it no matter what. And all these other guys are losers. I don't know how to do that.
And and then from your story on how your fund got started, it's like that's the reason why you're not willing to bet, on these on these just ideas, because it's not just, you're not this massive YC that has investors from all over. It's
And
you and your
I don't
friends'
have that
money.
skill set. I'm not really, other investors say they're great at reading people, and they know it. They know great founders when they see them, and they just bet on the people. And it's like, great. I'm jealous that you can do that. I don't know how to do that, so I just won't try.
fascinating. I think it's a great philosophy. That was one of the that conversation was incredible because I think the way that you broke that down and then were able to break down just the concept of a lot of these AI startups are really just little features within the larger platform or whatever. I haven't heard someone break it down that way, and it really, resonated with me and made sense because now every one of these tools, I had that intuitive feeling of like, this is just kind of like you said, it's just a regurgitated solution, and they're just APIing these LLMs and creating these solutions that they're not broad enough in scope to make a lot of sense to where it would make sense to bet on it. Because if there's 1,000 of them, like you said, how in the world can anyone really know, you know?
It's like the App Store for Apple. Like it's like OpenAI is, or GPT itself is like the new iPhone, and then all these wrappers are basically apps, and then it's how many apps are there? I think I use maybe like 5 on my phone now. It's the banking ones. I deleted the social ones, but that was pretty much it. And then, you have the text message and everything. Everything is now just a feature. It's the messaging, it's the calendar, it's the
Yeah, social is another area where every once in a while you get a spurt of a whole bunch of new social apps and trying to be niche. And yeah, I have no interest. It's so hard to get any traction. Yeah, it's like, and a lot of these categories, you think they're kind of made up. It's like, why do these people really need their own platform? Why can't they use Facebook or whatever else is flavor of the time? Because you see that, but yes, LinkedIn is a professional network, is a social network for professionals, and it took off. There are many others that didn't. But you say, how niche of a category does every profession need their own social network? The answer is probably no. You know, and I've seen that. I've seen probably pitch decks for social networks for just about every category you can think of. Socioeconomic category as well as professional category. I mean, it's funny, but I literally saw one like for Black women. Um, where social, it's like, okay, but they can have a user group within Facebook, but why do they need their own platform and would they use it? It makes no sense. There's nothing special about you. You're just artificially creating a category for no reason. There's nothing unique about the features of the platform. It's who you want to interact with on the platform is who you want to interact with. But how is your platform going to be different than all the other social networks? It's the same feature set. And that's the same thing with the banks. Is not They weren't providing anything different. They're just trying to cater to a different segment of the population. So it's niche marketing. But that by itself, I don't think is a good enough excuse to be a business.
Right. So at the end of the day, it's marketing. Like you said, you nailed it perfectly. It's niche marketing. It's not niche product building. It's not like the Go High level where they actually built real features for agency owners to make it make sense. It's just like, hey, we're niching down in the messaging or the marketing or the
Yeah,
positioning.
because the feature set, it's the same feature set. It's the same checking accounts and the same debit cards, and so what are you really providing them that's different? How is the need of this segment of the population different than the need of that segment of the population?
Man, what's crazy, we prepared for this with the mindset of, okay, we're talking to, last week we talked to a managing partner of a private equity firm. We're talking to people in private equity and family office, etc. And we were thinking, okay, how do we tailor conversations in which people in private equity that be listening to those type of shows, what could they get from someone in VC? But it's actually hilarious because what ended up happening is we ended up a conversation in which I think it's VCs who should be listening to what you're saying, because PEs think in terms of this business is an asset. It needs to be a business that actually produces money and actually can live on its own, and is not just going to get swallowed up because I'm taking my shareholders' money and putting them into a business that is really a feature. It's like the VC should be listening to you because they're just essentially lighting money on fire with all these rappers that you're talking about that are going to end up. There's no way they don't end up getting swallowed up.
Yeah, well, I can tell you something else though. I mean, I'm a VC. I'm also an angel investor. I'm kind of straddle both worlds there. Um, my VC fund won't have like the 100x kind of returns, but is also more stable. True, like Silicon Valley VC funds really need to not miss out on the next big thing, and they're okay. Like, say if they in portfolio construction, if they're going after a category, if they're going to make 30 investments in a particular category, they're okay if like 20 out of 30 go to zero, as long as two of them are unicorns. They're looking for that 100x, those fund returners. So they're okay making big. So they will go after a category and find like 100 startups all doing something, in that category, because they don't know which one's going to make it either. Even though they're saying they're betting on the founders, they will go in early on 100 of them and hoping that within that they didn't miss out on the next big thing. So they're okay if like 90 of the 100 go to zero. It's just a different mindset of investing. But that's literally and I'm not okay with 90% of my investments going to zero. But I also might miss out on that, 1000x return. I might miss out on the one that can come in at a $10 million valuation today that will wind up being like $100 billion company someday. Because because mine are less likely to be that. They're more stable. I can get 20, 30, 50x returns from some other portfolio companies, but they're also a lot less likely. And most of them will probably exit for like a 10x or a 20x if they do well. And the weaker ones probably, either go to zero or have a 1x or 2x because they sold, to a strategic. But I'm going to have a lot less zeros. I'm aiming for less than 50% of my portfolio to go to zero. It still hurts when I have a portfolio company shut down. And I do care about it as opposed to, because I said, I'm still an underwriter by heart. I can't get out of that mindset. So I have a harder time investing like in a whole basket of them saying it's okay. It's like going, it's like casting a net. And it's like, yeah, here's 100 of these. I love the category. Hopefully, within this net that I cast out there, I got a couple unicorns. I have a hard time with that. It's not a wrong mindset. It's a different mindset, and a lot of LPs want that. A lot of LPs won't invest with me because I'm not unicorn hunting. It's actually hard to raise money from LPs, except for people that know me and trust me. Um, and want to specifically be conservative, because it's not exciting, it's not sexy. The sexy pitch of going unicorn hunting is what gets the LP money.
That's really interesting. That's really interesting.
Again, say a third of each of my funds approximately is my own money, so I'm still acting like an angel investor, so it's a different mindset.
You would almost think that the fact that you have a bunch of skin in the game and that your risk profile is this way, it would almost be, you would think that it would be easier to raise money, but it sounds like it's not the case at all.
From other angel investors, from real estate guys, from conservative investors, yes. From those who are comparing me to the VC funds, if I go out there cold, um, you know, it's not a sexy deck compared to the VC funds that are unicorn hunting. It's just not. And yeah, my mindset is not as popular of a mindset in VC.
No, and the crazy thing is that most people don't even know that that side of VC exists. When you think conservative, like you're thinking of, well, let's buy a company that's already producing cash flow, that's already working, and that's more of the private equity world. So they don't even realize that the conservative side of VC actually even exists, and I think that would actually be massive. That's such a gap. DJ, have you ever heard of that? Um, when we think of VC, we traditionally only think of the unicorn hunters. That's the brand
So
name,
the
I
way I
guess.
think, my mentality is a lot like that of a lot of angel groups, and there's hundreds of angel groups around the country that are quite credible. Um, and angel investors and angel groups often think that way. They're more conservative. They're investing not to lose instead of investing to win. They're much more likely to invest in a solid business that already has good cash flow and just needs some money to grow, and that might have a 5 to 10x exit in 3 years, and less likely to invest in something that is very shaky today, but promising big growth and could be 100x in 10 years, but likely to go to zero. And now they'll choose the first one. They'll choose the conservative investment. And that angel mindset is still where I'm living in a lot of ways, where I'm okay with like a 10x exit. And I don't, and a lot of VCs will turn those down. They won't invest in anything that doesn't have unicorn potential. If it can't be at least 100x, they can't do it. And they'll look at a business and, you know, that's being valued at seed stage at, 10, 15 million. And they do their analysis and they say, okay, yeah, we see this. We see you doing pretty well. We see you eventually exiting to a strategic at 250, 300 million in about 3 to 5 years. But for that reason, we can't invest in you. And I'll look at that same business and say, for that exact same reason, I do want to invest in you, because we have different goals, different portfolio construction.
That's so cool. Well, David, I learned a ton from today's conversation. I didn't even realize that we're a bit over our time, and I want to be respectful of the time that you have given us. And I mean, I know I'm not just speaking for myself, DJ. I know you learned a ton as well having this conversation. So we just want to say thank you. Um, where can people find you? Where can they learn more about what you're building? They do want a bit more of the conservative VC side. where can they find you?
So emerging.vc is the website for our fund. I'm also on LinkedIn and all the other social platforms. So I'm pretty easy to find. And my blog, davidmandel.blog. Um, so I'm on the internet. You search for me, you'll find me.
Awesome. Well, David, thank you. And that is a wrap on another episode of the
Right?
Deal Flow Show.
Thank you, guys.